Avneet, Akash, such a pleasure to have you guys with us. Thank you for taking the time.
Thank you, Jake. Thank you for having us.
Thanks for having us.
Wonderful. We are excited about all the knowledge you're going to share with us. We said, let's get a bit of a precursor for a broader audience because the space you're playing with, like we were just talking, you are true in essence. As a fund manager, you are a true VC opportunity because you are solving a serious pain. GPs are upset that they're not getting liquidity. LPs are upset they're not getting liquidity, and you are the man giving liquidity. So I think they're putting this, we all go into the God status. So it's a must required need. It is, jokes apart, as an LP in about 10 funds, 5 of which who are still to give me DPI, vintage 10 years ago. I feel the pain, honestly feel the pain.
Sure.
And thank you for actually taking this bold step of creating ISF. To start, I'd love to learn more about your respective journeys and how ISF got together to start, how you both came together. I know there's a long history, almost 22 years ago. You've known each other for a while.
Yes.
So that's a phenomenal, friendship. Kudos to that. But let's start with you, Avneet. If you could just walk us through, your background and your journey, that would be great.
Sure. Jake, again, thank you for having us. That's a great introduction. So my journey started in Delhi, born and raised in Delhi, SRCC, US MBA, and joined AT&T straight out of business school. And that is actually where I met Akash. Both of us met at AT&T in the financial leadership program. I ended up spending 10 years with the pension fund, a subsidiary of AT&T called AT&T Investment Management Corporation. Akash did M&A, AT&T M&A. One of the last projects that I did at AT&T was building the Asian private equity program. We had no exposure to the developing world. And for us, emerging markets was just India and China. Invested about 4 funds in India, 4 funds in China. This is 2008 to 2011 timeframe.
Got it.
And from that, I got my next opportunity, which was to lead JP Morgan's fund of fund practice in India. And just last year, after having spent 12 years with them, stepped out to launch ISF. The seeds of ISF are almost a decade old. The Twitter handle that I got for ISF says 2016.
Oh wow!
But the journey was only consummated last year when the skeleton that I had got the heartbeat from Akash. And so that's probably a good handoff to Akash.
Akash,
thank you. Thanks, Jay, for having me. I think this is a great opportunity to share. I come from a small town called Devas in MP. Schooling from there, college SRCC Delhi, CACS from India, MBA from the US. And as luck would have it, met Avneet in AT&T in the leadership program. That meeting in 2003 led to starting of ISF in 2024. This friendship, we were talking about it for the last 5-6 years. But my journey has been not as straight as his. He went to AT&T and he went to JP Morgan. I had to do a bunch of things before I found my calling.
Sure.
I started with AT&T M&A team. AT&T got sold. I came back to India, worked with Sunil Bharti Mittal, did private equity. And then after doing all this, I realized, hey, let's build some business. And hence joined Snapdeal. Snapdeal journey I saw from 75 million in value to 5.5 billion in value.
Wow.
Raised $1.5 billion for them. And then post that, because I was at Snapdeal, I got an opportunity to work with Naspers and Process Group, where I built their fintech business. 8 years with them, 29 countries, lived on a plane, 500 million business, going to about 6 billion business. Smallest operating business of Naspers becoming largest operating business. And then, you always decide to leave something on a high.
Yes.
So decided to move on from there. And then as Avneet said, he's very kind. He's been doing everything about ISF for the last 6, 7, 8 years. But yes, maybe it was destined that we come together, a business builder and an investor together. to launch the secondary fund.
Phenomenal. What a story. Phenomenal. And nothing beats old friendships. I think that bond, and I've seen this in life, even with friends you went to college with, right? You could be whoever you are, but when you go and meet that person, you go back to being 21.
Yes.
You could be 55, but you're back at 21. So, and that bond is a very different bond. It's
Sure.
nothing you do today has any impact or material, weight to it, right? Because you're back to 21 or 25 or whatever that age was.
Yeah, and I maybe just one thing to add there, which is we are very complementary. So he's the smarter, he's the calmer. I'm the dumber, but I'm the mischievous guy, right? And a great combination. Yeah, we come together very well.
You need two people to clap, right? So, and that's the beauty of partnerships, is having that complementary set. Right? Someone sees something the other person doesn't see it, right? So, wonderful, wonderful. Let's jump straight into it.
Sure.
Avneet, the secondary space, especially in India, is new.
Absolutely.
Everyone's historically heard, "Arey VC karo, spray and pray." Of course, we've now heard that model is also its suspect. Now people are saying concentrated VC karo, right? Like we were discussing earlier, I'm also an LP in about 10, 12 funds. Been investing into the space odds from 2010. Some are now beyond their original term,
Yep.
waiting for somebody to help. Right now, the government had some new regulations on you can't keep extending the fund, right? So I think there's a lot of shifting pieces to this. So let's start simple. What is a secondaries fund? And what has happened globally? If you could just start with that and then we'll peel the onion.
Absolutely. So maybe just before I get into what is secondary, just a little 2-sentence refresher on what is primary private equity.
Sure.
Right?
Sure.
So primary private equity is investors called limited partners invest in closed-ended funds that are run by general partners.
Correct.
Right? Correct. That's the way any private market starts. LPs or investors committing money to GPs or investment managers.
That's right.
In a closed-ended fund model, a 10+2 model, 10 years plus 2 extensions.
Correct.
Now, in this illiquid asset class, there is no out. There is no redemption. You cannot say, I want out. It's not an open-ended model. And hence, in this illiquid class, if you wanted an exit, the only way to come out was through the secondary market. You sell your unit, you sell your holding, or you sell your commitment in the secondary market to a secondary buyer.
Right.
That is the genesis of the secondary market.
Got it.
And forever, this was a very small cottage industry. It started as most financial innovations start in the US. Right? So the first secondary fund dates back to 1980s.
Oh, wow.
Venture Capital Fund of America, VCAF, $6 million fund. The first secondary fund in the world. And then as the private markets started to get mature, the primary market started to mature, 10, 15 years go by.
Yes.
We start seeing the onset of firms like Kochar, Lexington, Landmark, Adrian, all started to raise $50, $100 million funds. This is early 90s, when the primary business is already 15 years old. That is probably the stage where India is today, where the primary market has seen about 10, 15 years. And now people are thinking about either liquidity or starting to raise new funds. But this cycle works best when LPs receive distributions back so that they can recommit.
That's fine.
And when there is not enough of a distribution cycle, there is a logjam. And to sort out the logjam, other markets have seen the growth of the secondary market. The other point that I would like to highlight is that the first LP transaction that happened in India was actually Kochar Capital doing it for ICICI Venture.
Oh, okay.
The other piece of secondary market, which has really come into prominence in the recent past, is this whole GP-led secondary model. The first part is the LP-led model. The LP says, I want to get out of a fund. The GP-led model has especially come about in these COVID years when people started complaining about having missed underwritings or having missed business plans because of lockdowns and all that. And GPs, by their own prerogative, are stepping up and saying, we will either set up a continuation vehicle or we need extra time or we need to hand over this portfolio to another vehicle. That is the entire GP-led model.
Got it.
And as you know, I was fortunate enough that JP Morgan actually did the first GP transaction in India. They took over the portfolio of a manager that was actually planning to exit India, and we actually executed on bringing exits to that particular portfolio. So that is essentially in a nutshell, a secondary market, a liquidity solution provider to an illiquid asset class.
Understood. And so I think we'll dive in deeper in the subsequent few questions, but just broadly, just so I get it right.
Yes.
I'm an LP. I can sell my LP stake.
Yes.
I'm a GP. I can sell my entire portfolio. I can even sell parts of my portfolio. Sleeves of
Yes.
portfolio. Correct?
Yes.
Fundamentally, 3 ways to slice the pie. Correct?
Yes.
Okay. Super. And in terms of trying to understand why today and why India right now, we certainly know there's pain, but if you could just walk through that piece and, Akash, if I can bring you into the conversation.
Sure.
Tell us more about, why secondaries in India today.
Yeah. So I think it's evolution of private markets, right? Like what happened in the West, where 1970s, 80s, private equity VC started. Then within private equity VC, different asset classes started, right? You start with minority, then you start with full all sectors fund, then you have venture capital, then you have private debt, then you have sector focused funds. And then in the end comes secondaries when you have the full market evolved.
Yeah.
So the West was between 1980s to 1995, 2000s, right? Now in India, we started seeing VC, private equity, etc. from early 2000s, which picked up pace in 2010, 2015. And then we saw a kind of deluge of private debt, right, between in the last 5 years.
Correct.
And now the critical mass is such. There is so much capital that has already gone into PE VC, sector-focused funds have come in. There is micro VC, there is VC, there is early stage, there are 10 different kinds.
Correct.
So today is the right time to actually do secondary as an asset class in India.
Right.
I will also highlight that globally, you have secondary market, which is almost 10% of primary, right? So globally, secondary market is about $100 billion because primary is $1 trillion.
Right.
Now, in India, in the first few years, we saw like maybe $5-10 billion of investment in primary markets. But in the last 7-8 years, we have seen $50 billion of investment in the primary markets, which essentially means that now secondary as an opportunity is almost $5 billion in India on a yearly basis. And that's why this is like absolutely the right time. I think if I were to explain in a very layman's language, when you have a large new car market, that's the time you have a used car play.
Right. Fair enough. Because today, when I was last talking to some of the SEBI guys, I was shocked. I met them at an event. I realized there were 8 of them in the room. I said, can we have a chat?
Sure.
They said 1350 AIFs in the country.
Yeah.
Right. They said, and we've given licenses to 250 more this year. And I said, wow. Like if I got into PE myself, back in 06, or like 10, 15 funds at that time were doing private buyouts.
Yes.
So at that stage was very rare. Today you're talking about 13, 50 funds. And it's and interestingly, they're now not talking about international LPs, they're talking about domestic LPs.
Yes.
So, coming to your point, Akash, the market's getting deeper. It's deeper by verticals, by assets, by so much variety, which shows maturity, as well as now all of them have to find a home, find an exit, return capital. And there was this one old saying that I picked up in Europe at a fund conference, which said, ideally, as an LP, you should be giving money only 3 vintages. You just keep putting money 3 vintages, and actually the model should work where it's evergreen.
Yes.
As long as money comes back for life, and a lot of European LPs were talking about this, where they've seen like $1 million check from 25 years ago was a $68 million position today.
Unbelievable. Yeah.
Unbelievable. And
Yes.
I'm looking at it going, and they said all I did was we put a million, 3 mil, and then it tripled.
Yeah.
And so when the compounding comes through, we don't ever have to go give money back, right? So we don't want money back, just keep playing.
Flowing back.
But after 3 vintages,
Yeah.
it's closed. But I think in India today, when I talk to GPs, that's where it's broken. I think that the need is of the secondary vehicle to show up so that money can go back to the LP so you can come to the fourth fund.
Correct.
Right.
Correct. I think we took the 10+2 West model for India.
Yeah.
And the 10+2 West model works when you have that underlying infrastructure.
Right.
The country was not ready at that time to provide returns in that time period. I would probably argue it is ready now. So the new generation GPs that you will talk to, they are much better prepared to answer the DPI question, which is, distributed to paid-in capital ratio and things like that.
Yes.
So the current crop of GPs are, in my opinion, much more focused on liquidity.
Right.
But that will be for vintages 25 onward. There is a huge...
It's a long journey.
Yeah.
Long journey. Yeah. So, but what I'd love to, Avneet, ask you is, if you could walk us through what is your strategy? What is the strategy at ISF going to be? How do you, like we just said, now it's a deep and deep universe. And I'm sure knowing how much pain there is, people are chasing you, saying, can you please do this for me? Can you do that for me? So how do you sometimes you wonder, you probably need $1 billion to solve the pain for a lot of people, but step by step.
Sure. Yeah. So we are going back to first principles, right? Our first principle is ISF is a liquidity solution provider in an illiquid asset class.
Yeah.
Right. That is our baseline first principle. That is the way we look at transactions. That is the way we look at our deal flow. That is our, foundation of our investment strategy. Now, how do we unpeel that and when we double click on it, how does it play out, right? The first is still the bread and butter of the secondary market is the LP-led transaction, which is where LPs commit capital, right? And 10 years is a long time period in today's world.
Yeah.
Right? We are in a time period where things change in 10-year time periods, right? And you mentioned the number of 1350, right?
Yeah.
That's a lot of first-time investors or LPs who have come into the asset class.
Yes.
And I would argue that some of them should not have come into the asset class. There is a certain maturation of your family office that should take place before you dive into a illiquid asset class.
Okay.
And when you get a drawdown or when you see a volatility in the market as we are witnessing right now, you're probably caught off guard with respect to, can I now truly fund capital calls across all the different funds that I committed capital to? And in a situation like that, when you're not able to commit to, the calls that you get, you go back to your GP and say, I am unable to commit capital.
Right.
And that is when either the LP or the GP will reach out to us and say, I have a issue at hand. I have a LP who is committed half, 60, 70% of the capital and is unable to do so because of various variety of reasons.
Yeah.
Could you help me solve this problem?
Right.
And our job there is to look at the underlying portfolio,
right,
and play out how this exit scenarios will play out for the underlying portfolio companies and see whether we can earn our secondary underwriting returns there or not.
Right.
So that's the LP-led piece.
Right.
The GP-led piece we briefly talked about before.
Yeah.
These are all, instances where the GP themselves is stepping up and saying, I would like to figure out a solution here because my fund life is coming to an end. But my underlying portfolio companies are not ready for a natural exit.
Right.
And hence, I need now time to take these companies from where they are to their natural underwriting exit, which could be 3 years out or 4 years out.
Yeah.
But my LPs demand money back now.
Right.
So what I will do is I'll create a SPV or people call it continuation vehicle, or I will sell a sleeve to satisfy liquidity requirements from somebody.
Yeah.
But we definitely need a third party to come in to take care of either of these, solutions that we are going to work out.
Got it.
And so this is the GP-led practice.
Understood.
Post-COVID, the GP-led practice is almost equal to the LP-led practice.
Interesting.
So last year, the global secondary market was about $150 billion. 75 was LP led and 75 was GP led.
Okay.
The other part of the equation is that sometimes change of personnel, change of guard, change of CIO, change of private equity heads also triggers secondary transactions.
Right.
So a lot of deal flow in the West also originates when a new head of private equity takes place or a new CIO takes place and they change strategy. And hence, when this was a cottage industry and there was a little bit of a taboo associated with secondary, that's all gone. Secondaries nowadays are a legitimate active portfolio management tool in an illiquid asset class.
Got it.
And so we are very cognizant of the fact that we will do LP-led secondaries, GP-led secondaries, and finally this special situation buckets where people will raise up their hand and say, I want to exit India, I want to exit emerging markets,
Right.
I want to exit the entire private equity asset class, I don't want to do venture anymore,
Right.
I don't want to do real estate funds anymore.
Right.
So, all these actions also trigger secondary transactions.
Understood. So there's a lot of variety there.
Exactly.
But from a funds perspective, for you all, will you only spend time with venture funds? Will you only spend time with PE shops? Is there a sweet spot?
I think, Akash, maybe you should take that answer. So
Yeah.
what we will not do.
Yeah. So great question again. I think we are not doing everything. That's the first part. So what we will not do is we will not do real estate and infrastructure because we don't understand that.
Sure.
We also don't want to do, while any sale from an investor to an investor is secondary.
Yeah.
What we will not do is very small percentages in companies. So if somebody asks me to buy, hey, because NSE everybody knows and there is secondary happening on NSE all the time.
Yes.
If somebody says, will you buy 10 lakh shares of NSE? No, we are not doing that. We are not in that play.
Got it.
What we want to do is we want to have reasonable size positions in companies where we can add value. Because the next 4 or 5 years, these companies have seen, let's say, a 0 to 10 journey in the last 10 years. And when we come in, and that's the beauty of a business builder and an investor mindset, right?
Right.
To say, how do I take from 10 to 20 before either the company goes IPO or the company is ready for an M&A or the company is ready for a strategic sale? I think that's the other piece that we want to cover. The third piece that we will not do is we don't want to do primary transactions. So we only want to do secondary transactions because of the fact that all the GP community and the LP community are essentially our friends.
Yeah.
And every time, and this is a collaborative ecosystem, right?
Yeah.
So every time there is a transaction where there is a secondary and a primary, we can do the secondary, but we can get our friends to do the primary.
Correct.
So that's the other part that we will not do specifically. And the last part, which is most important for a secondary piece, because investors are giving capital to a secondary fund because we are supposed to assume a certain level of risk for a certain level of reward. Now, we will not invest in loss-making companies where profitability is not in sight for the next few years.
Got it.
So this is, as Avneet calls it, this is our value approach to private equity in some sense, where the companies have already turned profitable or just about to turn profitable so that they can have a natural exit in the next 3-4 years. So very clearly defined, LP secondary, GP secondary, and then things that we will not do.
Got it.
If you were to take the risk spectrum of the private markets,
Yeah.
right? The most risky part is the angel seed part of the equation.
Correct.
Plenty of binary outcomes there.
Yes.
Right?
Yeah.
The secondary is probably the other end of the barbell, where we are not accounting for any binary outcomes. If you talk to a Western world CIO, and he's allocating his risk budget, in his private market, he's giving the least amount of risk budgets to the secondary managers and the most amount of risk to the private seed, early stage VC, Series A, deep tech kind of managers, right?
Right.
Now, if we start doing venture, we are messing up his risk budget.
Understood. You have to. It has its role. It's in the whole portfolio construction for any big investor.
Yes.
You are playing the risk-adjusted more secure.
Yes.
Correct spot.
And shorter duration private equity.
Sure. Correct. So that's a sweet spot.
That is our sweet spot.
Yeah. Okay.
Yeah.
And is it, just to come back to what you said about LPs,
Yeah.
right? Buying out an LP. Is there a ticket size that you like to buy out an LP? Because an LP, say, let's assume is in a fund that's $100 million fund. May have someone has a 1 million position, someone has a 10 million position.
Yeah.
What's a position that you would even consider?
So at this moment, as we are starting off and we are fundraising, I don't think we are being very particular about funds.
As long as there is value, it fits your thesis, you are good to go.
If it means that now come fund 2 or fund 3, where we have better line of sight of capital raising and all that, we might have some issues with respect to whether this will move the needle for us or not.
Sure.
But at this stage, we are open to all LP conversations.
Sober.
Yes. And there is another reason for that also, right? So we are in live conversations with a few funds.
Sure.
And there are some small positions that we have. Right?
Yes.
$1
million positions that you
$2 million, right?
Correct.
And goes back to the point that Avneet was mentioning, 1,400 AIFs, lots of LPs came in and now realizing that this takes a long time. But the reason we want to do today a $1 or $2 million position of an LP also is because that leads us to understanding the whole underlying portfolio, and we are sure that this is not going to be the only LP in the fund who will come for a secondary.
Correct.
So eventually it might turn out that I might be doing 5 LPs of $2 million each in the same fund.
Correct.
So the homework is already done.
Correct.
And then new LPs are coming. Yes, we are ready. We are okay to take this because we've already underwritten the portfolio.
Correct.
So that increases the position in the same GP for us as well.
Super. No, that's helpful.
If you take that math about secondaries being 10% of the primary market, right?
Yeah.
The corollary to that is that in every fund, there is LP turnover of about 10%.
Okay.
Yeah.
Interesting.
Right? So the way we look at it is that this first transaction that has come about, which is say that 1 million in that 100 million fund that you talked about, is the
first guy.
Is the first 1% of the 10% that will come through.
Correct.
So if you talk to a GP today, he will tell you in his fund life, there will be a 10 to 15% LP turnover.
No, it's so, historically, 5 to 7 years ago, when I talk to my GPs, they would never bring up this point. Sometimes, unless you don't poke them, they won't tell you stuff. And once they don't get to know you, once they get to know you well, then they'll tell you all their problems. But otherwise, they're always selling you the holy grail. But recently, right, they're actually, because as they also see us mature in our journey, I would invest in one fund, second fund, third fund, right? They're like, oh, you've got appetite, you've been a good partner. Oh, by the way, there is somebody you missed that vintage. That vintage, there is somebody who's got a $500,000 check.
Yes.
Do you want? I'll connect you all. You all discuss, discount karke aap le lo, right? Because you know us, less of a headache.
Yes.
I don't have to explain anything. You are in all my other vintages. You missed this vintage because of COVID. So ab aa jao usme, right? So it's interesting, which was earlier not there. And at Aikya, right now we have got 75 family offices, and I have a lot of one-on-ones with many of them. And unfortunately, there are also a few who got into or was sold this asset class as something that is just a requirement as an asset allocation.
Sure.
Ki alts nahi, how can you not have alts? 10%, 15%, you must put, here are 4 funds. And now I've realized that, we need liquidity because we're actually putting up a plant, or we're now going into manufacturing. We used to be in manufacturing, when liquid, going back. So now coming back to us as the founder saying, and so that's someone I should be sending to you.
Absolutely.
Because you're like, I'm ready to go, boss. And I have 2 folks who are saying, I'm ready to sell all my LP positions. Let me know if you want any of it. Right? So it's more coming because there's nobody for them to talk to today. Right? So some of them are like a total pie is 10 million.
Yeah.
Right? So across 6 funds is about $10 million. Decent and all good names. Names that even we would say, good vintage. You can see line of sight to good product. Right? So interesting. It's interesting to see how even the asks are coming in from our network.
Yeah. So go ahead.
Yeah. No, just to extend that point that you were saying, right? So we are in fundraising mode right now, right?
Yeah.
And we've had some very good conversations. But this is a new asset class,
Yeah.
right? And one has to explain the asset class, which is what you are helping us with your family offices by bringing us in.
Right.
But every time we have a fundraising meeting with a family office,
Right.
and if the first of all, the family office asks a question, what is a secondary?
Correct.
And after 30 minutes of conversation, the family office says, I have a secondary, will you do it? So there is proof of the pudding in
There,
right?
exactly. You're staring at the pen.
Yeah.
Yes.
Yeah.
That's right. And it's interesting now. And this is a sort of a little bit of a sidebar question, because I was in New York last year, and I was talking to some folks there about secondaries. This is in June, and they said secondaries are happening at a 5, 7, 10% type discount in New York. I found that number very, honestly, not discount, and these are good funds. Obviously, people are buying between family offices. There was no fund involved, but they're saying 10% off.
Yeah.
What are the discount rates in this game? How does that work?
Yeah. So the discount part of it is something that people have started to game a little bit, right? The first part of the equation is that because secondary investing started about 2 decades ago in the West, there are now about 170 secondary funds in the US.
Wow.
Right? So when there are that many number of players, the price becomes, demand and supply curve. We all studied that back 101, right?
Yeah.
Like perfect competition,
Correct.
and that is the reason why discounts get squeezed. The other part of the equation is that what you hear are discounts of only GPs that are actually being traded. There's a full cohort of GPs that do not trade because nobody wants to touch them, and nobody wants to come up with the headline risk number of the fact that the discount number there is 25, 30, 35%.
GPs don't want to trade.
Yes.
So for an LP to exit, the GP has to bless that exit.
No, even if they don't bless it, there's nobody buying that LP commitment.
Because the portfolio is not worth.
Portfolio is not worth it.
Right.
It's not trading in the market.
It's not trading.
Yeah.
So
Stuff that is trading is the high quality, GPs, Fund 10, Fund 11, excellent track record of generating liquidity, right? So that is trading at, there's sometimes a bidding war between 90 cents, 91 cents, 92 cents.
So the numbers I got were fair.
Fair. But that also differs according to market.
Okay.
I suspect if you land up in New York this week, that number is probably different.
Fair enough. Fair enough. Yeah, I think it's all depends on the broader environment too.
Yeah, it's to some extent guided by the the bullish nature of the overall financial markets that we lived in, right?
So 100%. It's like 2021 here, right?
Exactly.
Anyone want Baiju's at 25 billion? Going cheap?
Yes.
Today's a whole lot different. But let's come back.
Maybe just while discount is important, discount is not the only thing. You mentioned Baiju's just now.
Yes.
If you would have bought a secondary in a company like Baiju, even at 90% discount, you would have lost money.
Right.
Goes back to the point of why we don't want to do loss-making companies. Also, your underwriting has to be very, very strong with what Avneet said, exit focus. Saying, how am I going to exit in the next 4 years or 5 years?
Yeah.
Because I have to return capital much faster to my investor than the classic PE and VC.
True. Well, that's a very fair point. I mean, I think we are sometimes the desi brain says, what's the discount?
Yes.
But the truth is, what's the value underlying, right?
I always keep going back to the first principles, right? The reason people allocate capital to secondaries is because this is on this side of the risk spectrum. It's a value-oriented approach, shorter duration approach to private equity. The moment I do a loss-making unicorn at a high discount number, I have deviated from my principle. I have deviated from the strategy for which investors have given me capital.
Right. No, fair enough. That really helps put it in the right mindset and mind frame of where you are playing. Let's jump quickly. I want to understand on a no-name basis, if you could share some of the pipeline, that would be great to
Sure. No,
but maybe before
sure.
your question on that, he mentioned the right side of the spectrum versus left, right? If you are an investor in a secondary fund, and if a secondary fund returns to you 5x, you should not be very happy.
That's a lot.
No, you should not be very happy.
Why?
You should question. You should ask, looks like you took too much risk to give that return.
That's a VC.
Yeah.
Right.
So then you are not a secondary. So one has to be very mindful, which is where we are aiming 2.5 to 3x.
Correct.
Right? Because a reasonable return, 25% IRR, we are not talking of a 40% IRR. That's not our business.
You're not going to see a 10x.
Correct.
You will see a 10x.
No, we will not see it.
No, that's not the
correct.
That's what you're investing in.
If it happens, that's luck.
Yeah.
We didn't underwrite it.
Yeah.
It's good virtue.
What, a 3 to 5 is
2.5
to 3.
Yeah.
Correct. It is fair. I mean, you're right. I think that's a very important point you brought up, which is how do you if a secondary fund will deliver the 5x, that means it's obviously played.
Yeah, that's a VC fund masquerading around as a secondary fund.
That's right.
Yeah,
that's right.
That is not what. It is great because it worked out.
Yeah.
If it hadn't worked out, that could have been a negative performer for you. May not have returned capital to you, which is an absolute no-no. Secondary funds not returning capital is not tolerated in the West.
Yes.
At all.
Sense. Yeah.
Because that is the allocator or the investor did not allocate you that risk.
Correct.
If you start behaving also as he has a VC lineup.
Yeah.
He's allocating risk to them, not to the secondary guy.
Yeah. But I think India still has to wake up to this thought.
Yes.
I think in their mind, in Indian LPs minds, a fund is a risk. I'm playing it simple.
Yes.
But the truth is I meet a lot of investors.
Yes.
But which is why it's important to have these discussions.
Yes.
To share that knowledge is that there are now verticals that are better risk adjusted.
Yes.
Returns where there is the chances of a washout don't exist. Right?
We have been talking about this.
Yeah.
I suspect what has happened in the last few weeks, people will actually also listen to us.
Yes.
I think while we have been advocating about risk and risk-adjusted returns and things like that for the last, 6 months that we've been now fundraising or so, I think that message is going to become a little bit more clearer in this environment that we sit in today.
And this is actually empirically proven also. To say risk-adjusted return, you said, he mentioned, right? There is a research done by Cambridge Associates, 20-year period.
20-year period.
2000 to 2019. Covering about 2,600 funds globally, maybe more, slightly more, and about 200 secondary funds, 1,000 private equity funds, 1,000 VC funds, etc. On a risk-adjusted basis, secondary is the best performing asset class. And what I mean by that is, while secondaries may not give you 40% IRR or 45%, which is the top 5% of VCs you can get there, secondaries but the top 5% of secondary funds will be between 35 and 40% or 35, 36%. But the other side is very important, which is in VCs, you can go down to minus 15 at the bottom performing funds. In secondaries, the bottom performing funds are plus 5%.
Bottom of plus 5%.
Yes.
So very tight range of IRRs.
Right.
So if this is the range of IRRs for secondaries, this is venture.
Yeah.
Right?
Yeah. And hits and misses.
Yes. So again, I suspect, Ajay, that while it is a new asset class, it is being very nicely received. I think Indian family offices are exceptionally smart people. While it is new, they're getting it. They're understanding the point about risk-adjusted returns. And we are going through this education cycle, right? So people are now getting more and more familiar with Sharpe ratios and, the under information ratios. Risk-adjusted return is actually catching on with folks.
Good. It's good news. Yes. I mean, I guess with 1350 funds, it's about time.
Yes. Yes.
So you want to talk
Yes.
a little bit about
Sure.
sort of what's in the pipeline and on a
I'll do some LP-led and Akash can take some TP-led transactions. There is a Southeast Asia-based fund of fund. 13-year life has come to an end.
Okay.
They have exposure to about 15 underlying funds that are still alive. Of these 15, there are about 4 managers that are India-based. And this is a transaction in which we are going to each of these 4 managers and underwriting portfolio of each of these managers and saying, how do we generate our 2.5x return?
Right.
And coming up with the pricing. So this is basically a fund of fund that's shutting down because their life is over.
Sure.
And we are buying the India's, at least we're bidding for the India piece of it.
India piece, all 4 funds.
All 4 funds.
And you have to buy the entire.
No, we think we can pick and choose line items.
Oh, you can.
But from the seller's perspective, they much rather have 2 or 3 buyers as opposed to 13 buyers.
Sure. Right. Yeah, it's easier for them too. But they here in this trade, you would step in and they would entirely leave.
Yes. So we will become the new LPs in this because it's an LP-led transaction.
Right.
We will be the new LPs in these 4 underlying funds. ISF will be the LP.
Okay. Interesting.
Yes.
Okay.
And some of the smaller transactions that we talk about, I think those are a dime a dozen right now.
Yeah.
People are beginning to default on capital calls.
Yes.
And here the math that we need to do is, because these are not fully funded portfolios, whether we can accommodate in our 7-year life. Because these are 2021, 2022 funds. So still very, they've called half their capital, 60% of their capital.
Yeah.
That means they have life that is going on for 10 plus 2.
That's correct.
Right. So we're trying to figure out, while in some cases we like portfolios, we think that, it's going to do well. But it's going to be a little bit hard for us given that what we are.
Just from the duration perspective.
From a duration perspective.
It's hard. Yes. Yeah, that's actually, I didn't think about that. That's actually, you have a different duration.
Yeah, we are much better suited to do LP-led transactions where the entire amount is already funded.
Correct.
So this is year 6, 7, 8 of the underlying fund. Because that matches with our duration profile.
100%.
Plus, we always want to underwrite assets. We don't want to get into the blind pool business. So when a fund is fully funded, I can much better underwrite the portfolio.
Got it.
If it's only half funded, I don't know where the other half is. That's the blind pool piece of the equation.
Got it. Yes, of course. Yeah, it's an unknown.
Yes.
How do you price that?
Yeah.
Correct.
And coming back to that, Akash's point, not interested in primary. So that piece of us is primary for us.
So it's more complicated than it looks.
Yes.
I think externally people, I think sometimes even families say, secondaries, I get hundreds every day.
Yeah.
Every banker in town calls me, says, NSC le lo, ye le lo, OYO le lo, Incred le lo. Like it's almost, so why should I be paying somebody to buy me secondaries?
Yes.
They're talking about secondaries of individual stocks, individual.
Highly traded names.
Highly traded names.
Yeah.
That's a different beast.
Yeah.
You're not getting into that, like you say. That's not your space.
No, buy and hold is not our space. We would like to get into situations where we can impact the exit to some extent.
Sure.
Akash, you want to talk about
Yeah, and so you talked about LP. GP-led transactions, again, I think there is enough opportunity. You started your conversation by saying evergreening is required.
Yes.
So we've seen transactions where people are now thinking about their fund 4, etc. And they need to show DPI.
Correct.
Right?
So
they need liquidity from their fund 1 asset or a fund 2 asset or a fund 3 asset.
Correct.
You've seen a transaction like that.
Correct.
That's one example. The other example is...
But I'm sorry, if I can pause you there. They need liquidity from an asset, which is not a company you're saying then.
No. So they will sell companies there.
They will sell companies.
Yeah.
So a pool of them.
Yeah, a pool of...
From like a fund 1.
Correct.
Ki aap le lo.
Correct. Exactly.
But you're as an institution versus dealing with, say, individual family offices, for them it's preferred because you will buy a few.
Yeah. So there is full portfolios,
Yeah.
which is GP-led transaction, which we've seen.
Yes.
And full portfolios, reasons could be different. Reasons could be evergreening. Reasons could be first fund now wanting to do the second fund, need to show exits.
Correct.
Right?
Yes.
Then there could be sleeve of portfolios, which also we are seeing.
Which also are doing.
We are where people are saying, hey, cut my portfolio into half and you take the half, give me the DPI. I am on year 8, year 9. I need to show 1.5x DPI before I go ahead.
Correct.
Right? That's the second GP.
Correct.
There is a third piece where GPs are wanting to continue. They have good assets. Fund life is coming to a close. They believe in the assets, but they are saying, hey, look, we want to continue to run these assets.
Okay.
So it's more a LP replacement initiated by a GP. So continuation vehicle,
Right.
where these two assets I'm going to transfer into a new fund, and you replace all my LPs, and I will continue to be the GP. That transaction also we are seeing. And then there is a fourth class, which is also very important, which we will do very selectively, but that single asset. Now, these single assets are not like what we talked about, 100,000 shares of.
And it's
Yeah. These are companies that we have known for 6, 7, 8 years. There have been GPs in that. They are already sitting on 4x, 5x.
correct.
The company will go IPO in the next 4, 5 years, but the GP wants to exit. We understand the company very well, which is why we will do single asset GP secondary as well.
Okay. So that's also an option.
Yeah.
Like a $1 billion, like a $1 billion, $2 billion company, maybe.
Correct. Yeah. That is also
Still primed for 30.
Yeah, I can share a company's, like, there is a company which is $60 million in revenue, $5 million in profit, will probably hit $100 million next year. I've known the company for 7, 8 years. They will go IPO in the next 2, 3 years. Very good company, good space. The investors own 35% of the company. Now, I may not be able to do the full transaction.
Yeah.
Right? But I will do $20, $25 million transaction there.
Right.
And then bring balance other larger secondary players if they are interested to co-invest with us.
Sure. Interesting. Like you earlier said, business builder, investor combo, right? In a lot of folks' minds, this is secondaries mein hai kya kaam? Kya kaam karna hai? It's a financial trade.
Yeah.
Someone is selling, I am buying, I have to fix a discount rate, I have to value the assets underlying, and bas, thoda upar niche karke I had to assemble a portfolio. How hard can this be? However, obviously from a strategy perspective, as you guys both shared, this is a much more nuanced business than it looks like from outside or gets credit for. And this business builder piece, right, which is a very interesting one. So help me understand the business builder angle to a secondary trade.
Sure. So I think 2 parts to it, right? One part is, what's the most important thing in a secondary fund? The most important thing in a good secondary fund is, can they underwrite exits in the right manner? Like layman's language, escape room philosophy.
Right.
कमरे में घुसने से पहले बाहर कैसे निकलूंगा वो सोचना है.
Correct.
Right?
Correct.
So now, and exits happen through IPO, through M&A, through strategic sale. For that, you need to be at a certain size and scale. That's number one. Number two, you need to have that network where you can go and push for a strategic sale or an M&A, or you need to have an experience of an IPO, right? And number three, like scaling that business, in that process, can you take that company there? So, look, 0 to 10 is a journey that is done by a VC, or let's say from early stage private equity to growth. And then when we come in, we don't want to be like, I want to actually work with the founder of the company, add value in the business, be on the board of that company, and help that company scale. I'll take an example from my personal career. I've been on the board of a company called V-Mart Retail. That company in 2010 was 20 stores. Today it is 500 stores. The company we took public 5 years later. Today that company's stock from 200 trades at 3,000 rupees.
Wow.
And I've still been on the board and I've seen that journey. Now, of course, I don't want to like push down the throat of the founder to say I want to add value. But I think I've seen enough in the last 15 years of my business building career that we think that we can add value. That's part one. Part two is this whole what I did at Process, right? So you acquire companies, you scale companies, and then you either take them IPO or you do exit.
Correct.
So this is coming from experience to say how do you create value, and this is an essential ingredient for exit,
Correct.
which is the most important thing for a secondary fund.
100%.
So that's the reason why this coming together is important.
Oh, no, I agreed. And thank you for sharing that roadmap. One other big thing that folks get, and we touched upon it a little bit, but just check with you. You guys said you won't touch any distressed transaction. Doing secondary just means you're buying at a fair price, right?
Correct.
Super. So, what do you feel, since that is out of the table, what do you feel are the essential ingredients for you to get into a secondary deal? Is there a, say, top 10 checklist that you could share? What makes a good secondary deal for you?
So, well, whether it is top 10 or top 5, I really don't
either
know.
ways.
Yeah, I think the first for me and for Avneet,
Yeah,
for any investment,
Hmm.
is the founder and the team. That comes number one, right? Because I think that's like ISF is called India Secondary Fiduciaries, right? And that there is a reason why fiduciary word is there. So we want to work with founders and the team which can scale the business, right? That's the first part.
Right.
But I think the second part is we look at business model, we look at business companies and where they are, what stage they are, where is the space today, and then how can we exit those companies in the next 4 or 5 years. I think that's predominantly it. I also mentioned that companies which are already profitable or are about to be profitable with 20-25% growth rate for the near future.
Correct.
We are not underwriting 100% growth rate. If that happens, great.
Yeah.
But that's not what we are pushing for. I think those are some of the essential ingredients when you look at a GP-led secondary, and within that, when you look at underlying portfolio. This is coming from a business builder mindset.
Sure.
Now, the thing for LP-led secondaries, what you will look for is something very different. Maybe Avneet can comment on that.
Sure. So on LP-led situations, the number one thing, Jay, we are looking for is the mortality of the GP. We don't want to get into situations where we have doubts about whether the GP is going to exist going forward or not.
True.
We want a GP which has been successful. There is a team, and there is enough and plenty there for us to see that this GP is going to survive for the next few funds. And so that becomes very crucial. I think, again, going back to first principle basis, right? The lens through which a primary investment is done is very different from the secondary lens. You talked about, how some people say, hum bhi kar sakte hain.
Correct.
Right?
Yeah.
The primary lens is backing a founder, adding new lines of business, growth, M&A transactions, maybe adding more products. Can we go from India to international markets? The secondary lens has none of those.
Correct.
The secondary lens is very simply, is this company exitable in the next 5 years? What does it need to do? Where should the revenue be? Where should the expense profile be? And what kind of multiples will it trade at year 3, 4, 5, 6 on from here on? We are not building, hockey stick growth curves. We are not building, new product launches. We're not building new lines of businesses. The simple secondary lens is the exit-focused discipline.
Got it.
And, it is not something that comes to people intuitively. Intuitively, people get to primary investing very nicely because that is how your mind thinks about equity investing.
True. Yeah.
This is because I keep coming back to the fact this is a lower risk product. This is a risk-adjusted, value-oriented private equity.
Yeah.
It is a much different, thought process. The first question that I see that Akash and I have to answer to each other is, can we figure out an exit for this portfolio in the next 5 years? And now the other part of the equation is there's also a lot of self-fulfilling prophecy here, right? Yeah. Now, having done IPOs of Bharat Matrimony, Car Trade, Happiest Minds, right?
Correct.
We can take that playbook to the founders and say,
Correct.
this is what we did here,
Right.
and that helped this founder.
Correct. Yes.
Your credibility is a notch higher if you've done a little bit in the past with respect to, and by the way, you can talk to these founders and ask them what we did to help them increase investor relation profiles,
Correct.
better talent,
Right.
and once you do another one, and that adds another, it becomes a very nice, instead of it's a self-fulfilling prophecy to some extent, right? But
Sure.
you tend to get regarded as somebody who will come and help in the exit process.
No, it's interesting to have that lens, to saying, you're looking, while everyone says exits are, the number one rule in underwriting for any guy in private equity, where is the exit? For anything I enter, I have to figure out the exit, right? But to actually have the experience, right, which you've had, right, in getting those companies public, in you building in PayU, Snapdeal, right, all that experience global, to sort of how do you take a company to the level where it is either it's monetizable at a good price, right? I think those are skills that they can definitely take home.
At the end of the day, we all have a limited amount of productive hours.
Yes.
Right? What we feel is that in India, exits are a full-time job. It's not a part-time job. Akash and I are not spending time on the latest AI. We're not spending time on figuring out the best, API out there for pharmaceutical companies or healthcare or hospital delivery or anything like that, right?
Sure.
We are spending our time solely on figuring out exits. Now, for anybody else to say that I will also be searching new founders, new technologies, and managing my existing set of portfolio companies and fundraising and managing teams, and also exits is not an afterthought for us. It does not come, priority list number 3, 4, 5 for us. It is priority list number 1, 2, and 3. That's all we want to do. That's all we do. And if we don't do that, we will not have a secondary fund that is a successful one.
Sure.
In order, the mission statement of ISF is the premier secondary fund for India. In order to do that, that is our single line of focus, exit generation.
Perfect. I think that's the music to everyone's ears, in India at least, because exits have been the hardest struggle.
Yeah.
Even though markets have had opportunity.
Yes.
I think some have exited in time, some have not.
Yeah.
And I think from what I'm realizing, it's a slice of the pie within alt assets.
Exactly.
It is required, right? It's like the fourth pillar.
Yes.
Of the gate. Yes. And it's required so that the engine keeps chugging along.
Yes.
Otherwise, right now all of us know we're living in a bit of a stuck game.
Yes. Log
right?
jam.
The log jam of, fifth fund. I'm on my fifth fund, Jay. Why aren't you putting money after putting money in the first 3, right? How do I give you more money when the first 3 are stuck?
Sure.
And so even all of them are running to your doors to say, help me give him some money so you can come back. That logjam needs to clear up. So,
and that is what our hope is, that as, sophisticated family offices start to, figure out in their larger private equity portfolio what portion should be secondary.
Correct.
Right?
Correct.
And that's the education process that we are going through right now. And that is the, and your event is going to help a lot there.
Sure.
And our various conversations that are happening out there. And we are very confident because the underlying premise is that these people that we're talking to are very smart finance and investment professionals.
Correct. Yeah.
It's just a matter of providing them with a solution which they never knew existed.
True. I think the need of the hour.
Yeah.
Right? And so it's timely that you are, set up and able to capitalize on this. I think it's been a phenomenal conversation. Thank you so much for sort of demystifying the space. I think education is the first part of anything. And to have this conversation openly, discuss the different silos that come in between and the complexity that is required and the exit focus, that's so important.
Yes.
Otherwise, today, everyone wants to run their own horse and says, "Main bhi kar sakta hu." What's the big deal, right? But the truth is to understand the complexity is very important. And most folks don't get it. I think the amount of verticals you all went through to have 4 different buckets and then to have the skills to work through each of them is important. So thanks. Thank you for sharing, Akash, Avneet.
Thank
Wonderful having you with us.
Thank you. Thank you so much.
Our pleasure.
Thanks
Love
for
it.
hosting us. Thank you.
My pleasure.